Hello traders, due to the fact that there is lots of information regarding stop loss at the internet, I would like to tell you a bit more about it, which stop losses to use, which stop losses not to use and why. First of all, some words about types of stop losses. So we have fixed stop loss, timing stop loss, structural stop loss and mental stop loss. Also, volatility-based stop loss, which is my favorite. So, to start with which ones not to use, the first one I would say is a fixed stop loss, then mental stop loss and structural stop loss. Why? Well, it's all because of different type of things. So first of all, I would like to tell you about fixed stop loss. So what is it? Let's say your money management system is not letting you lose more than 2% a deal and you've decided to spread it over 15 pips. So you have a fixed stop loss of 15 pips. Why not to use fixed stop loss? Each instrument behaves differently. Volatility is different. Seasoning, during different periods of the year, market is moving differently. Another thing is a mental stop loss. You're choosing a level to consider it as a stop loss. When the price is closing above or below the level, you're manually closing a position, which seems to be like it saves us from manipulations and false moves. But the reasons for not using it, please answer this. Will you be able to close it manually, seeing your position gain losses? Or will you wait how it will become profitable and then close it? Our mind is moved by fears, so it's better not to let it to take over. While you wait till position is profitable, you fail to enter the profitable positions that potentially would cover your losses. And what is the most important, you are draining your account. Structural stop losses, what is it? Well, the market is moving up and down in swings, creating highs and lows within a perfect world in a bearish direction of the market. Next low is lower than the previous one, and next high is also lower than the previous high. And in a bullish market, we are getting higher highs and higher lows. Let's see some samples. Uptrend. Higher highs, here and here and here, and higher lows, here and here. So placing structural stop losses in uptrend is under the structure, which is lows in uptrend. So we have the first low here, the second low there, and with the blue squares you can see the stop losses. Well, basically it's a high lows. Let's assume that we're right in where the market will move, and we have entered the market using a buy stop here, or a limit order here, and we placed a stop loss over here under the structure. Just to remind you that, well, you can see that the slide is changed a bit. So our stop loss unfortunately has been hit. And we lost. In our buy stop position we lost 70 pips, and in our limit position we have lost 22 pips. So what's bad about it? The stop loss is too large for a buy stop order. Stop loss is okay for a limit order, or if trader is using price action approach, breakout of a pattern entry, as the stop loss at the same cycle length with the pattern itself. So what is bad about it? The structural points consists of limit orders, stop loss orders, breakout entries. So it's a dangerous area for stop losses. Too much volume around the area, even if you give it some space, the stop loss will be triggered with a larger loss. Thinking to place a stop loss in the area of potential entry is wrong, as it will likely to be triggered just to cover the volume of orders at the area. So what shall we think about to place a right stop loss? Current market condition, volatility, volume depends on the market you trade, FX is a bit different. So volatility-based stop losses are the best, very easy to apply, doesn't need much thinking to apply considering all the market conditions. Simplest approach is average true range. Average true range of the set numbers of periods. In other words, the average size of the bar or a candle depends on what you used for trading. It is believed that the normal size of the channel is ATR times 3. Usually the ATR times 2 stop loss is used, but sometimes it's ATR itself and sometimes it's ATR times 3 and even more. It has to be studied over certain instruments as it can differ. It can be applied to the most recent highs of an uptrend or the entry point itself. As you can see from the previous samples, the lower you enter in an uptrend, the higher in downtrend, the smaller the stop loss is used. So depending on the approach you use to trade, ATR stop losses can be placed here. The first ATR itself stop loss for the buy stop entry can be placed over here. The second ATR times 2 is placed over here. And ATR times 3 is placed here. So for our limit order, the ATR times 1 is placed here, ATR times 2 is placed here, and ATR times 3 is placed over here. Trading approach, money management and stop losses are always coming together. Stop loss is a must-have part of the game, any professional trader will tell you so. But the approaches can be so different, so it has to be a part of the whole trading system of yours. Do what you prefer, take a few small losses or one big and wait for a larger earnings. It's all up to you. Any questions are welcome. Contact us through our website or directly using our Skype or email. It's all dedicated to your trading success. Thank you very much for your time.